All right, so this...
That's a PhD.
That's a PhD. Punished to the corner. So I wanted to, this is as much an event about data as it is an entrepreneurial event. I know for a fact there's a bunch of people in the audience who are entrepreneurs starting companies. So just to take it, maybe to a little more of a personal level, and James, you started mentioning some of this, but I'd be curious about your entrepreneurial journey, especially with the founders in the group here, how you started and what led you there. You want to start, Renaud, maybe?
Yeah. So what gave me the idea of Lending Club was really a personal experience. I was on vacation, and because I was on vacation, I had way too much time on my hands, and I actually read a credit card statement, which I wouldn't otherwise do, and I realized that if we were going to carry over the balance to the next month, we'd be paying 18% interest rate on our credit card. And the same day I was opening up my savings account statement, my high yield savings account statement, where I was earning about 0.4%. So it really felt like a big spread between these two rates, and for what seems to be the same money that you give to the banks and that the banks give back to you. And so the very basic question was, okay, is there a better mechanism, better way to allocate capital between depositors and borrowers, and would a sort of online marketplace be more efficient than the current banking system? And so I started talking to a number of people in the banking industry. They all told me I was crazy, which was further encouragement that it was worth exploring.
And then quickly, what did you do before? What led you to this? How did you become an entrepreneur?
Yeah, so I started my career as a lawyer, as a lawyer in Paris. And in 1999, my law firm decided to send me to New York, which was New York in 1999 was really the perfect time to quit a law firm and start a internet or software company. And at the time, I met another lawyer who also happened to be in New York. His name was Turck. And
also French.
Also French. So we decided to start a company together. That was our first company, which ended up being acquired by Oracle in 2005. And so after staying for about a year at Oracle, which was part of the deal, I left Oracle and I went on vacation, and that's when I bumped into my credit card statement.
Great, thank you. Noah, what about you?
For me, I've been working in the New York startup community for about 12 years now. My last company was an enterprise software company called Tacit Networks, and we sold that in 2006 to a publicly traded company. I wasn't OnDeck's founder, but I was the first employee in the door. And so I think what attracted me to the original idea was simply sort of two things. One, I really like the dynamic of the incumbent who was encumbered by regulation, size, and inability to innovate. In my enterprise software days, I was competing against the best and brightest in Silicon Valley and all these other places. I felt like I was in a backwater, but here in New York. But the nice thing about this opportunity was, it just wasn't clear if this was a segment in terms of small business that the banks were really excited about, had the capacity to innovate in, and I thought that data and technology could make a difference. By collecting electronic data on small business, you could really make a different kind of loan decision in a much faster time frame. So I think it was just that sort of industry dynamic was really appealing, and I thought, what better place, I wanted to stay in New York, and so I figured fintech was a great sector to focus on, given that New York is kind of at the crossroads of both of those industries, and that's really proven to be the case in terms of OnDeck.
Thank you. Jeff?
Well, this is my sixth startup, and the way we got into this is kind of a similar story in that I was saving and could find a place to save money at about 4.5%, 5% a year. Thought that was was excited when I found something that was 5% instead of 4.5%. And then we were talking to some of our employees, and they were excited because they got approved for a loan at 5% a month. And these are really very employable, hardworking people. And I thought there's got to be some sort of arbitrage between, as a saver, saving 5% a year, and as a borrower, being willing to pay 5% a month. So we allocated the resources to sort of start digging into it. We had 4 people working full-time, just unearthing, everything they could about this opportunity. And that's when we learned about microfinance. And that got us even more excited. We decided to drop everything. And we had before started a business in the big data space, sort of a pre-cloud big data company, which I do not recommend doing. So we were very familiar with kind of dealing with these large semi-structured data sets. And then the first business I ever started was in and around the internet, and the idea there was, it just was such a big change that I figured it would make up for the fact that I had no idea what I was doing, which proved out to be correct, that it was big enough to make up for the fact that I didn't know what I was doing.
What's kind of amazing about this market to this point is that, so you guys are doing those amazing things, building those rapidly scaling businesses, but alternative lending is what, 1%, 0.5% of the overall, consumer finance industry. What does it look like in 5 years from now? Is there a sort of like a number of like sort of low-hanging fruits, and you guys are covering those, and then you're going to face some resistance, or is that all accelerating from here? Maybe James, since you can start, since you or not.
Sure, I'll speak about it in one segment of it. So I think in the of those regulations we talked about before. So I think it's Basel II, where if you're a bank, they look at your credit card portfolio, and if it's above 4.5% loss rate, and then anything above that, you have to hold 100% equity, risk-weighted assets 100% against that, regardless of how profitable you are. So I think what that means is that banks are going to be very timid when it comes to segments that might have higher loss rates than other segments. And so just focusing on that for a second, I think in 5 years, you're going to have a lot more people, a lot of new entrants focused on that, doing well and growing. And I don't think you're going to see too many banks coming to compete there. In fact, I think what you'll start seeing is partnerships. You'll see some of these companies that actually, I think, some of the panelists have demonstrated this already, where you'll see partnerships where banks might use a service. You think they have this big branch and retail network, but they might use the service of a new emerging company to help them make loans faster in their branches, for example, or make loans to certain segments of populations that they really can't, from a regulatory perspective, get behind. And so I think the way it's going to go is the world of us thinking that we, to like Renaud's point, putting money in a bank, getting nothing, and then guess what? The bank's not even really lending it. I think that's going to go away, and in the future, it's going to be people figuring out how they can more directly invest their money in spurring lending. In China, was it Alipay raised like $80 billion in like, I don't know, 10 hours or something, for basically investing in kind of lending. So I think that's the future.
Yeah, no, I think that's right. I mean, we all have a very bright future in front of us. I think we can really sort of collectively transform the entire banking system and make it more transparent, more consumer-friendly, and more cost-efficient than it is today. But I think we all came to the realization that we're better off transforming the banking system in a way that's not necessarily confrontational with the banks, but associates the banks to the transformation. I think it's going to be a more constructive effort. And I think Noah and I, 3 days apart, announced a partnership with a large bank.
Not the same one.
No, not exactly. But it's...
Which one was it?
So we announced a couple of weeks ago a partnership with Union Bank.
We were a BBVA Compass, so yeah.
So Union Bank is a sort of $100 billion in assets, one of the top 20 banks in the country. They have 1 million customers in California, and what they found is they have 1 million mortgage customers, but they don't have an unsecured consumer lending product. and they found that Lending Club can help them make loans to their customers in a way that would be more efficient than Union Bank making these loans directly. So it's really a combination. It's really the best of both worlds, where platforms like us, like ours, have a low cost of operation, and the banks have a low cost of capital. And when you put these two together, you can really drive down the cost of credit for consumer and businesses.
Is there any reason? We talked obviously a lot about data. In a perfect world where, with years and years of history that you guys are building and you're getting, more and more data set, and you're able to make better loans, is there any reason why you couldn't just conquer the entire industry? I mean, is there a limit to how good all your models can become?
Well, I think one thing I'd point out is you're mixing small business and business lending with consumer lending, and there are many things that make them different from the data sets that you work with, and then the other thing that's very different is U.S. lending versus emerging markets. And there are hundreds of millions of people moving into the emerging market middle class, educated, hardworking, that essentially, as far as the traditional financial services are concerned, they don't exist. So you really have to look at it across, really as 4 different segments, and I think there's different opportunities to introduce radical efficiency into all of those.
Okay, I want to open the floor to some questions. Otherwise, I can keep going. One over here.
I think it's Bill Gates who is said to have said banking will always be needed, but not necessarily banks. Do you think that is a likely prediction?
Well, I think the Alipay example was pretty interesting. They amassed $42 billion in assets through essentially a wallet in 6 months. Because money is inherently social, and we now have mobile access, we may see very fast changes in how we think about money management and money movement and lending. So I'd be willing to go out on a limb and say that there is a top 10 global financial institution that is not today is thought of as a internet or non-bank type company. It maybe Alibaba, maybe Tencent, could be Facebook, could be Google, but I think these network companies are very well positioned to be big players in financial services.
So my question is about the interest rates.
Name and company, please.
Okay, I'm Ariel. I work for Data Miner.
That's a good question. Yes. Okay.
What is the minimum interest rate that someone can get from you? What's the average, and what do you think in the future? What's the lowest that you can get? I mean, because it's arguably the interest rate is the big part of the innovation that you're bringing, because at the higher interest rate, probably a lot of these applicants can get loans.
Yeah, I think that's a great point. So our rates start in the single digits, so it's 6.5% for consumers, 5.9% for businesses, and the average is in the low teens, so about 12.5%. And I think that's a great point, that's part of the innovation, and so the way we use data really helps rank risk better and give a more fair interest rate to consumers and businesses, but also the marketplace dynamics of it really helps drive interest rates down. Right? It's what we've noticed so far is as we gain a longer track record, and as investors have more confidence in Lending Club as a platform, investors demand a lower risk premium to invest on Lending Club. And so that helps us really lower the interest rates on the consumer side, and which drives positive selection in terms of higher credit quality borrowers, which further and more less negative selection and better data and better performance, which in turn helps improve the track record which further sort of lowers the risk premium that investors demand. So it's a really nice virtuous circle, very nice flying wheel that helps sort of continue to make credit more affordable and really drives down interest rates.
A little bit to that point, like one big question, especially around P2P initially, was what happens when interest rates finally go back up? What's the latest thinking from you guys on that?
So yeah, as far as we're concerned, that we don't think we're rate sensitive at all. Most credit cards, since the Card Act, most credit cards are priced at prime plus, so they automatically adjust up when interest rates go up. So in that scenario, we'll most likely increase our own interest rates as well. So we'll continue to deliver as much value compared to credit card to the borrowers, but we'll return a higher return to investors. At that time, investors will have sort of other fixed income opportunities that also generate a higher return, but our sort of spread over the risk-free rate will continue to be the same. So all these rates move essentially in parallel.
The other point I'd make, just building on that, is I think not only does the spread move, but usually the rates rise in a slightly better performing economy. So unless you have a real kind of stagflation scenario where the economy is sort of going sideways and rates are rising, defaults should come down a little bit to correspond. So we think our overall cost structure will stay relatively fixed, even in a rising rate environment.
So one or two more questions. There was one over there with a mic.
Bruce Harris, Lab 49. Sounds like you're all using data to drive the decisions that you're making about your business. Some of you spoke about the technology that you're using to do the analysis with that data, but most of you have not. Would you be able to speak to the tech stack that you're using to crunch the numbers and do your analytics?
I guess I can go for that. So at OnDeck, we primarily use R and Python to build our credit models and marketing models. Our tech stack primarily has been Postgres. We're migrating to Hadoop. And I think that's pretty much it. Do you have any other more detailed questions?
What about Lendo? I guess you...
Yeah, we are. So our data science team, our stack is now entirely in Python for everything. We converted everything from R to Python, and in terms of database, we're pretty database agnostic. We have, I spoke a lot about how database doesn't really matter, so we put the data in sort of a giant data store and use it as we want.
And a little bit to James' point earlier, what do your data sciences team look like? In large companies like this, are we talking about like 2 people, 100 people? What is their background? What have you found makes a good data scientist in the context of your industry?
I can go first. So we have a data science team of 8 people. They're based in New York. This is in a company that has 80 people in 4 different offices around the world. We have a mix of PhDs and programmers and developers and English majors. I think there's different skills. Your data goes in many different places, and ideally you want to have a mix of different kinds of skills, because people think about data differently. More often you find that where you find the data or what data that you use is actually more important. Abra and I were actually talking before, and no companies ever failed because their math wasn't good enough. The models aren't good enough. I think James was talking about that as well. It's not about how many PhDs you have. It's a question of how many different opinions can you bring to the table, and how effectively can you use what you have.
I have a similar story. Someone came to me one day and asked me, what should I learn? And I said debating, simply because we've never had a scenario where we went, oh, this guy did stochastic calculus 1. If only he had done stochastic calculus 2, he would have been awesome. That's just not the case. Most of the math we do isn't necessarily that complex. It's more about it's important to be skeptical about your data. It's important to be critically analyze your data. And a lot of the PhDs, I think if I look at my PhD, the main value it has given me is the confidence to reject overly sophisticated methods because the simpler ones are better.
All right, let's do one last question and then we'll go drink upstairs.
Hey there, guys. Jeff Tannenbaum from Oriema Consulting Group. We're a boutique firm focused on consumer lending and payments. And first, I just want to say I really admire what you're all doing, and I think you're on the right side of history in terms of where banking and payments and lending is going. I was having lunch with someone from the CFPB recently, and he was saying that P2P lending is starting to get more prominently on their radar screen. How are you guys thinking about compliance in a world where they're going to start to look at it more closely?
Be compliant. That's how we've decided to conform with the law in all jurisdictions in which we operate. That's good policy. And we're in 7.